All right, everybody. It's a little bit afternoon, so we'll go ahead and get started. We'll probably end up with a few more people on here. My suggestion to everybody today, if you wouldn't mind, is go ahead and keep yourself muted unless you need to say something, which we're happy to do. I think the way we're going to run it on this one is Todd's going to take over in a moment, and he's going to have the loan officers here do different sections. He's got a PowerPoint that looks amazing. And we are here to learn a little bit more about what's going on in the mortgage world today with all the changes. So at the very end, I believe, we'll do a Q&A as well. So write your questions down. You can throw them if you want in the group chat. I'll try to moderate that as we're going. But I know we've got a prepared presentation from all the loan officers. And yeah, let's go ahead and get it rolling, Todd. And if anybody doesn't know Todd, this is Todd Flannery with Equity Mortgage Group. He's the sales manager, and he's doing an amazing job with his crew. So thank you for hanging in there with us, Todd.
Well, thank you, Kyle. Thank you for the kind words. Thank you for all the behind-the-scenes help getting this set up for us, the flyer and the Zoom and all that. So it's greatly appreciated. I think you had some help from Caitlin too, so shout out to Caitlin. I'll kind of click on this real quick. Oops, I didn't want that. Start slideshow. Hold on. Okay. There we go. So first off, thank you, all of the RE/MAX agents who are sacrificing their valuable time to get on our first inaugural Lunch and Learn. So a big shout out and thank you for attending. Number one on my list, beyond mortgages, beyond selling homes, helping buyers, is making sure and checking on you guys that you, your family, friends, co-workers are all being safe and healthy as we deal with this coronavirus thing right now. So we don't get to see each other except via Zoom, but I'm thinking of everybody every day, my team and my partners and the whole RE/MAX family out there. So we just want to make sure everybody's doing their best, hanging in there and not going stir crazy like a lot of us, with or without kids, right? So that's number one. Part of the genesis of putting this together coincides with the impact of the coronavirus that it's having on the mortgage industry specifically and the housing market as well. So my team and Kyle and the partners on your side of the fence thought it'd be a great idea to put together a lunch and learn centered around all the news that we're hearing. Some of it's accurate. Some of it is a little misleading. So we want to make sure that you guys understand the volatility that's going on out there, deal with the uncertainty that's out there, and answer as many questions as we can. In turn, hopefully by doing this, you're going to help your clients on the listing side or on the buy side quell their fears as well. So that's kind of our aim today. I will introduce the team, which probably most of everybody knows. We've got Anthony, we've got Bob, Jackie, Jason, Stephanie, and another Jason on that though. So I wanted to throw their team. You can't get mad at me because these are pictures you have posted on the home equity page. So these are the only ones I can get. I don't think Anthony has a beard anymore right now. Do you, Anthony? If he's on. He was having troubles getting on, so hopefully he'll get on. Here's the agenda for today's Lunch and Learn. Volatility and strength, I'll cover that. Why it's not going to be like 07, 08 for those of you that were in the business back during the dirty word subprime and the financial crisis and all that happened. We got a good piece on that. Federal Reserve, mortgage-backed securities, rates, how all of that is intertwined together. And Jason Gard is going to speak to that piece. Appraisals, we had some directive from Fannie and Freddie on that, with some options in case we can't get full appraisals, and Jackie will speak to that. Verification of employment, big topic. Obviously, the economy has been impacted. I think the stat we saw this morning was now over 6 million people who are unemployed. So this is a huge ripple effect into the employment world. So our verifications have to be squeaky clean these days, and Bob's going to cover that. Product and program updates. Again, we've had a lot of changes there that are specific to the industry, and every company is dealing with those differently. So Stephanie's going to educate you on what Equity Mortgage Group is doing specifically. And as Kyle mentioned, we'll do a Q&A wrap up at the end, but please do make this interactive. If you do have a relevant question, raise your hand for Kyle, and we can take a look at it. I would recommend, just like any Zoom type call, is if you have a granular level one-on-one borrower question on Mr. Smith, that would probably be best to take that specific example offline. Reach out to me after, or reach out to your loan officer after. But if it's general and to the content and needs to get clarified, please bring that up, okay? All right, we got an apple and an orange. So we're both fruit as far as my formal education goes. We want to touch on some 5 simple things that are going to dispel the myth that the coronavirus impact is not the same as the subprime housing bubble burst in 07, 08. And I can certainly speak to that because I was on the wholesale subprime side during that time period. And my company was one of the last companies standing, but in the end, it did get shut down. And that whole industry sector was wiped out. Volatility, I mentioned that already. It's a different type of volatility than it was in 06, 07, 08 because what was going on, and we're going to speak to those points here in a second. But a lot of people have a lot of fear going on right now, both whether it's mortgage people, real estate agents, and more specifically your clients out there wanting what's going on in the market right now. Do they think it's going to be another 07, 08, the housing burst and all of that? So we'll get into that. For those that were in the business back then, it was a different time. There was a housing bubble, as you can read here, that was created by many different dynamics going on. And there's an actual index that measures that. And we'll cover that in a second. Basically, the higher the index, the easier it is to get a mortgage. And back in the day, we had a term called, if you can fog up a mirror, you can get a loan. You probably remember that, Jackie, or some of those that were in the business back then. So obviously, things changed. Government came in, Frank Dodd Act, Financial Reform Act, CFPB. We corrected all that stuff. Here's the chart. You can look at back in June of 04, 05, 06, it hit its peak. We crashed. And this is the mortgage credit, how easy it is to get a loan. Boom, CFPB was created, came in, took over the mortgage business, tightened things up. And you can kind of see as we get into 2018 or 17, 18, 19, starting to loosen up with a little bit of a dip down, which is today. And why is it dipping down today? We'll speak to that as well. So obviously we have tighter qualifications for people to get loans these days. Number 2 is prices are not soaring out of control. I have another graph here showing the annual house appreciation over the past 6 years compared to 6 years leading up to the height of the housing bubble. This is a good chart here to take a look at. The annual home price appreciation from 2000, 2005 periods, and then the period of 2014 to 2019, vastly different. You can see the comments on the right side. If you take a second to take a look at those. Number 3, we don't have a surplus of homes on the market. We have a shortage. And I'm sure all of you can relate to that here in the Portland metro market with inventory. I don't need to go into reading this because you guys are the experts and pros on the supply demand side, inventory, when it becomes a seller's market, when it becomes a buyer's market, and all of that. So, but the point is, we don't have a surplus. We have a shortage. This is a national number. It's not a Portland Metro number, but you can see the big difference from '07 to today. Number 4, houses became too expensive to buy. There's a affordability formula that takes into account the wages, home values, and mortgage rates. Back then, we had, what, 6% rates, wages were low, and, values were high. So that's, we had that bubble going on here. But today, we're in the, mid 3.5% on a conforming 20% down purchase type deal here. As you can see, average family pays less for their of their monthly income towards their mortgage payments. And this is a great graph here that illustrates that. Percent of median income needed to purchase a medium-priced home. Again, these are national numbers. 2006, let's cut off a little bit, sorry, 25.4%, but look at today, 15.5%, okay? People are equity rich, not tapped out is, again, for those that were in the business, a lot of folks, California was a big part where people were treating their equity like ATM machines. That's not happening today. People are, one, far more prudent in using their money. They learn their lessons. And so that dynamic, which was part of the cause of '07, '08, we're not seeing that here today. And this graph illustrates that really well. And there's some commentary on the right-hand side if you want to take a look at that. The total home equity cash out then was $824 billion. Today, $232 billion. So huge decrease on that component there. So again, we're in much better shape. Bottom line, if you're concerned, we're making the same mistakes that led to the housing crash. Just take a look at the charts and graphs above to alleviate your fears. So that was the point there. Is the coronavirus going to impact the mortgage business? Yes, it has already. And my expert team will go into details on that. But we're not going to see that same crushing burst of a housing market like we did back then. It's just not set up for that, and we're in much better shape. So we got some positive right there. Next, we're going to have Jason Gard, Suburban Southwest. Jason is going to speak on the Federal Reserve, MBS, mortgage-backed securities, and rates, and how that is all going on in our mortgage world. So I will mute, and Jason, you can unmute, and you can take over your spot, and tell me when you want that slide up.
Okay. Yeah. So go ahead and throw that slide up right now. So I picked a slide that sort of shows the volatility in the mortgage-backed securities market. You can see how this sort of went off the rails in March here. And the Federal Reserve really has sort of saved us. They've sort of stepped in and helped support the markets. I mean, all of this really started, we got a massive supply of new mortgage-backed securities hitting the market from the refinance boom. This sort of came at the same time there was a dramatic drop in investor demand for mortgage-backed securities. So anytime you have an increased supply of something and a decreased demand, it's going to push prices down. Well, bond prices and mortgage rates are inversely related. So that pushed rates up. And I'm sure most of us remember a couple of weeks ago, rates actually spiked to the high 4s really quickly. Thankfully, the Fed stepped in with quantitative easing. They began buying up mortgage-backed securities in the open market. They also did cut their federal funds rate to essentially 0. That really doesn't impact us so much on the mortgage side. That's more, it will cause rates to go down on home equity lines of credit, business loans, credit cards, especially things that are tied to the prime rate. What's really been helping us is their mortgage-backed security purchases, and they've really stepped up. I mean, last week they hit a high of $50 billion a day, which is just outrageous. To put that in perspective, that's 10% of all loans that were originated last year they bought in one day. And so they have really stepped up and said, we are going to support this market. They've since decreased that a little bit. They cut it down to 40 into the 30. I think what ended up happening is it ended up pushing up the prices for mortgage-backed securities too high. That does help rates, but it also impacted a lot of lenders negatively. So when an investor, or I'm sorry, when a lender funds a loan, oftentimes they'll keep it on their books before selling it, right? Well, to hedge against changes in the market, they will short sell mortgage-backed securities. When they got this big spike in the price of mortgage-backed securities, this really caused a lot of margin calls. So on a margin account, they let you trade typically up to 50% of the asset value and go on. So that's caused a lot of lenders to actually not fund loans, to put their rates really high, or not even offer rate sheets anymore. So it's a lot that the industry is dealing with right now. You know, it's really, what's interesting is typically mortgage-backed securities, the correlation between mortgage pricing, rate pricing, and mortgage-backed securities is about 95%. That correlation is less than 50% now. So you have a lot of factors other than the MBS market that are driving mortgage rates. So they're really going to be all over the place depending on the lender and the loan program. Lenders are far apart. Gosh, I looked at Wells Fargo the other day. They were at 4.625 on their FHA loan. We're still in the low to mid threes on our loans. So it's really going to depend on the actual lender. Our company's done a really good job of managing our pipeline, managing our cash flow, and we have not run into these issues yet.
Excellent, Jason. Does that wrap it up for you?
I absolutely. I mean, if of course, if there's questions, I'm happy to field those as well. But
Kyle,
right now,
anything?
I think it's
okay. Kyle, any questions that come up on the board?
None yet.
Okay. Well, we'll take that as it.
I think maybe the bottom line. Well, I just want to add one more thing. I think the bottom line here is that we just need time. The markets have to figure out what's going to happen with people not making mortgage payments and how this is all going to play out and all that. So I think we'll need some time to work all this out in the mortgage market. That's it.
Yeah, totally true, Jason. And for everyone that's on the call, I'll kind of ad lib just a little bit. I'm not sure if everybody knows that Equity Mortgage Group is technically a joint venture mortgage company. That has nothing to do with our day-to-day operations and your partnership with Jason and his other loan officer partners and myself. But just to touch on it, to help all of our RE/MAX agents understand the strength that we have behind us, because part of that joint venture, half of it is connected to Stearns Mortgage, and the other half is through Chad and Chuck at RE/MAX out of Colorado, and RE/MAX Equity Group here in Portland. And being tied to Stearns, again, we're not a branch of Stearns. We're our own independent mortgage company in that sense, although Equity Mortgage Group is a DBA of Home Mortgage Alliance out of Colorado, which Bill's the president. And most of you have met Bill. Stearns is a top 20 mortgage banking company. We don't have an existing active huge billions dollars worth of servicing, which is important right now because the servicing platforms have seized up. That whole arena is not doing very well. However, we will start servicing our own loans, like most companies right now, because the large servicers aren't accepting loans. We have $2.5 billion of warehouse line capability, $80 million cash on the books, strong liquidity balance sheet. Blackstone, the largest private equity firm in the world, has ownership of Stearns, and they just added a board member to their board of directors who used to be the chairman of Freddie Mac single family homes. And the CEO of Stearns is in daily talks with him and getting some guidance from somebody that was, the top dog at Freddie Mac just not too long ago. So our leadership is strong. our cash is strong, our warehouses are strong. All that's in real good health as it connects to our joint venture down to us at the local level at Equity Mortgage Group. So thank you again, Jason, and we'll move along. Next is Jackie from Hillsborough. Jackie's going to speak to appraisals. There's been a lot of talk going on about the guidance from Fannie and Freddie, so I'll let Jackie take over.
I think we may have lost Jackie, to be honest with you. Jackie, are you there?
I was kicked off too for like 5 minutes. I just got back, so she may be logging back in.
All right. Todd, can we go to the next one for now? Can't hear you, Todd.
I said you're going to mess me up if I get out of order.
I hear you. Technology is great when it works, right?
Hold on 1 second. Yeah, I just got a text from her. Got kicked off Zoom, trying to get back in. Yeah, so we can, let me see if, well, my next presenter lost connection too. Stephanie, are you there?
I'm not sure if I'm here. Am I here?
I can hear you.
You can hear me? Okay.
Yep.
I'm here then.
Let me
I
see
mean,
if
I don't see myself, so.
We see
I
you.
can see you and hear you.
Okay, well, cool. Good news.
Give thank you, partners, for being patient. I'm not going to claim to any one of us are Zoom aficionados right yet. It does happen at my house
Plus, we're all
occasionally
at
where,
home on
depending
our
if the kids are,
which are, you know, not as great as being on the cable at our offices.
right, and as we talked about, if you got kids on Xbox, I had to kick them off of it. All right, Jackie, are you on? Paging Jackie.
Jackie is not here yet. I'll keep an eye out. Why don't we go ahead and move on to the next person, and we'll go from there.
All right, Bob, are you on?
I don't see Bob on here either.
All right, those two are the next ones. Okay, Stephanie, we're going to have to ad lib and shoot right through you, okay?
Yeah, that's fine. You're gonna shoot me to my slides?
Yep. I will. I have to fast forward. Well, let me see. Let me escape. Is that Jackie?
Yep.
All right.
Sorry.
Good timing. All right, you're on.
Okay. Sorry. We're going to go really fast. All right. For appraisals, they have changed a few things up with the appraisers and requiring them to actually go into a home for safety reasons, which is kind of good so that we're not, sharing additional germs. But FHA has said that on regular purchase, so meaning no new construction, existing homes, that they can do a desktop appraisal, which basically consists of them pulling the information off the internet to where they don't physically have to visit the home, and they can get the comps from the normal places that they use, or they can do an exterior only. So they can drive by, take a picture of the outside. They are not requiring them to have any sort of interior photos or take a picture of the back or the sides or anything like that. So just from the street. So for safety purposes, it's kind of a good thing. So it's not the case on if it's a new construction or construction to perm. They are requiring a full appraisal. If they are making exceptions, if the let me get my notes. Sorry. If either party does not wish to move forward with the interior inspection, the appraiser may forward with exterior only, with additional conditions. Lender may direct lender or broker may direct the appraiser to conduct an interior inspection, and they can basically waive that if needed, again, just for to keep everyone germ free. So also with USDA, they're allowing some exterior things on, again, no new construction. Full appraisal required on new construction or construction to perm, as well as VA. With the VA, they are, again, these are all kind of temporary guidelines, to where they can do on a vacant property for VA, they are letting you do sorry, I lost my notes here. Purchase refinance. Everyone must agree that the inspector or that the appraiser can enter the property, that they don't have symptoms of fever or cough. So there's a lot of details that are keeping everyone safe on everything. We are still getting kind of on those things on regular conventional ones. We are still getting appraisal waivers, which is very nice. But you kind of have to hit that magical number of 20% down and purchase only. So, and it can't be on anything new. It has to be existing to where there are comps that the system can say things have sold in the past on this. So we are getting a little bit of some leniency on that, and also just to protect everybody. From Susan, what about conventional appraisals? Yes, they are allowing them to do exterior only. And again, we're trying to, Todd, did you ever get from our big boss Bill confirmation on that? Whether or not everything for sure is moving towards this, or it's on a case-by-case basis?
A great question, Jackie, and very timely. Thank you. So if everybody's listening, EMG Home Mortgage Alliance, we're still placing the order or requesting a full appraisal. These are what we are considering alternatives. If the clients are requesting this, we can't get in the house because they don't want the appraiser carrying germs into their house or anything like that. Anybody that makes a request, we're going to honor that request and go to these alternative options. But in all case, to make sure that we have a insurable, sellable file, we want to at least attempt to get a full appraisal up front. So these are deemed alternative options.
Yes, thank you. So yeah, and then we are running, I believe Bob put in, Bob, are you on? He put in a request for appraisal today, and we're about 3 weeks on that turn time. And I know that I had some stuff that were about 3.5 weeks right now as well on turn times for appraisals. So again, we are trying to make it, there's been a lot of changes, so we are trying to make it as easy as possible for everyone to continue their business. But the turn times are getting a little bit longer. So just please bear with us and know that we are doing everything that we can to get our appraisals done and keep everyone safe in the process. So if anything additional changes, we'll let y'all know.
Thank you, Jackie. That was excellent. To that, I'm not sure if there's any questions, Kyle, but Jason or anybody else on the team, we did have our call, and we have seen an increase in some of the cost of the appraisals.
Oh, yes.
So just something to just
add. Yeah, I was going to add something, but Jason, if you want to, you can.
Anyone having issues with values? I have not had issues with values. I do know that on, hold on, I highlighted something on the VA, Barbara. It says that they are not enforcing, there we go. VA will suspend the ROV requests for cash outs for further notices. So if the appraisal comes in low on a cash out, they're not going to fight them. They're not going to deal with it. And also suspend any repair assignments until further notice as well. So really they're saying that's going to come in as is unless something is significantly wrong that they are looking at so that they don't have to go back into the home.
Hey, Jackie, you might want to say what RMV is. I don't know if everybody knows what that means.
Sorry. It is reconsideration of values. Sorry.
Oh, hey, Stephanie, to answer your question, no, I actually have not had low appraisals. I just got one in today that was $15K over sales price. So
yeah,
the values are still.
I haven't had any value issues on my side of town. I am on the east side. I also haven't had 3-week appraisals. I haven't had one take 3 weeks yet. So I'm glad Jackie's saying that they could, but I just want to reiterate that it's really, you know, up to kind of the area and where the property is located on how long they are taking. Also, just want to make a note that it's, you know, same thing with supply and demand. Appraisers can ask for an additional fee if they think the property is, you know, too far or unique or something like that. So we are on the cheaper end of appraisals that usually costing on conventional around $600. I am seeing some added fees on to appraisals of like $100, sometimes $200, you know, depending on the property. So we'll want to make sure that you guys know that up front, especially those of you that are taking advantage of the free appraisal. It's only up to $600 that we offer on that. And I just ordered an appraisal yesterday and I have a due date back of the 12th. So that's a 10-day turn time. I might have got lucky. I'll admit that. So that's not necessarily the norm. So just be aware that depending on where it is, it could take up to 3 weeks.
Mm-hmm. And my 3-week appraisal is on the east side, is over in Oregon City. So don't know why it's, and we asked for a rush and they tried to charge us like $400 for a rush for a few days faster. So we said no, because that was a little ridiculous. They're trying, and again, this isn't everybody, that was just this specific appraiser. But I did get today an appraisal waiver on a brand new purchase. So that was nice that my client won't have to do an appraisal, which I appreciate.
One other note, sorry guys, as a little hint to realtors out there, it's just a little tiny hint, but on my stuff I use, I always have the buyer's agent listed as the contact for the appraiser to get into the home. And so by all means, we don't get to have any contact with the appraisers, as you know, but by all means, if you can talk an appraiser into getting out there quicker, or if you've got a lockbox and it's vacant, and you know, it's always a good idea to, you know, maybe ask the question if there's any way they can get to it quicker. Sometimes they'll just flat out tell you no, but anyway, that's just a little tidbit of info that might help.
Jason?
I was just gonna say, it seems to be hit or miss. I had the 2 previous appraisals I ordered before the one yesterday were about 2 and 2.5 weeks. But I just ordered one today that was an 8-day turn time. So I think it's really just depends, like Stephanie was saying, it just depends on where you are and, you know, how many appraisals are happening in that area.
Good points. All right, we'll move on then. Thank you, Jackie and panel.
Any realtors have any questions on that part?
I think we're good so far.
We'll take that as we're covering the material. Next, we have Bob. Bob up in Vancouver.
Yes, sir.
He's going to talk about verification. Pardon me?
I had a connection problem.
Verification of employment. I can hear you.
Yeah, okay, cool. All right, so I'm going to be talking about what we classified as the final VOE, verification of employment, or verbal verification of employment. Standard procedure, what's been going on forever, was what our processors would do about 10 days before the note date. They would do a verbal verification of employment just to make sure our bars were still working, because I know folks that have been around a long time, and we've had stories way in the past where sometimes that tripped up stuff. But the verbal verification Our final VOE has had some changes to policy from Fannie and Freddie due to our wonderful COVID-19 situation. And they're changing very quickly. They first came out with saying they wanted to move that 10-day from note date final verification of employment that the processors do to 5, and that lasted about 2 days, and now it's down to 3 calendar days prior to the note date. So what they're doing, and they've changed the forms they use. They get on the phone, they make the call, and they have a script on a form from the old days. Now it's a more detailed form that has been updated, questions that need to be asked, and of course these questions are totally dialed into the COVID-19 outbreak. They want to know if there's been any changes to their business hours of operations, likelihood of continuation of income resulting from the outbreak. If the employer indicates there have been any changes, it's like a little mouse, they got to go down another path. They got to confirm rate and type of pay, hours worked have changed. They have to document everything. And then it's the what ifs if they get these answers. There's certain industries at an elevated risk, and the list they've given out where they're going to scrutinize more: travel, tourism, leisure, hospitality, entertainment, automotive sales, personal care, restaurant, retail sales, and fitness. So if our borrowers are in those industries, they're at an elevated risk. The final verification of employment is going to be scrutinized a little tighter, kind of an underwriter judgment call, but it's quite detailed what the form comes out with on what they have to do at this point. The thing I want to emphasize on the 3 days before the note date, before, when you had the 10-day, you would do the 10-day and then you had plenty of time to, CD and docs. Well, with a 3-day, that means a CD will go out. You're pretty much going to be drawing docs and doing a final VOE about the same time. If maybe right after the final VOE, their verbal verification docs will go out, and just be a note that if your borrower is in this, especially the elevated risk industry, this can be really scrutinized. A lot of detail is going to be asked if they have an effect on that. Also, self-employed borrowers, that's the one that's gotten even more scrutinized. They have to have a letter of explanation written, and it's not just a couple sentences. It's very detailed on what kind of effect, if they're still open for business. If it's a retail entity, the underwriters will Google and check to make sure that business is still open. So it's pretty crazy. I had a self-employment that did close at the end of March that we had to rewrite our letter 3 different times because it had to get so much detail. And they're going to ask for, if they haven't done their 2019 tax returns, they're going to ask for a 2019 profit and loss and balance sheet from that self-employed borrower. If they have filed those, they will do a year-to-date 2020, P&L and balance sheet, which in the old days, they wouldn't ask for that right now for 2020 until about 6 months into the year. So it's, again, real scrutinized. Obviously, there's some concern and the validity of the loan if somebody loses their job. But again, just wanted to emphasize that because we don't want to be tripped up at the end, which could happen. So I'm just in saying that. I know all the other fellow mortgage loan officers, myself, in the very beginning of doing a new deal, you're just going to have to really scrutinize and ask those questions right up front and attack that right at the very beginning so we don't have any surprises at the end. Get these letter of explanations right in the very beginning on initial underwrite. Maybe prepare and set expectations to the borrowers especially if they're self-employed, or if they're working for a company, ask a lot more details about their type of work. I've got one going on right now. He works for Freightliner as a trainer. No effects is happening with his job, which is nice. So, we're not going to run into that, hopefully, but it is, and it's changing every day. So right now, that's where it's at. And obviously, if change from that, we'll be the first one to let information out on that. Any questions or
Hey, Bob.
concerns?
Can you hear me?
Yes.
Did I mute myself? Okay, cool. It's Jackie. You may have said this. I may have missed it because I was reading the screen as well. But just there's now a new part of the verification of employment that has to deal with COVID-19. that states that their job is not affected by it and that they will continue on their employment. We had a borrower that they had to redo the VOE, verification of employment, 6 or 7 times because of that, because the employer was not addressing COVID-19. So that's a big thing that needs to be addressed with those verification of employments. And again, you might have said that, but just my nice horror story.
Yes, they've actually got brand new forms out that got all these detailed questions asked
Yes.
on them. I was looking at a couple of them today, and they're rewriting those probably even more so. But yeah, how those are filled out and how those questions are answered is going to dictate whether there's going to be additional requirements needed for the verification or not. And obviously overtime and commissions is a big thing, because if an employer comes back and says, oh, I can't guarantee that's going to happen, then we're obviously not going to be able to use the overtime or commissions. If an employer says due to COVID-19 we're not paying out any commissions or something like that, then that's not going to be used in the equation. If it was being used in the beginning of starting the loan and it's going to go away at the end, that could have an adverse effect on qualifying, which might end up resulting in borrower not qualifying anymore. So they're really big on checking on that stuff. Bonuses, commission income is really, once they want a really solid feel that has not been affected, it's going to continue because of COVID-19.
All
I'm
right.
going to add just
So yeah,
one
it's
thing to
just
that, if that's
a lot more
okay,
detail,
Todd.
a
Can I add
lot
one
more
thing?
detail.
Go ahead, Stephanie.
Okay, sorry, Kyle. Just one thing, if you're self-employed and there's not a way to really get a verification of employment, like Bob mentioned, they're requiring that letter, but they're also at the end, in lieu of the verification of employment that we're sending over in writing to the employers, they're requiring some additional information from the self-employed borrower. For instance, if it's a realtor, it would be things like purchase contracts, listing contracts, whatever you can prove that, signage that you've ordered or marketing that you're doing. If it's another type of business, they may require receipts, invoices, proof that projects are still doing, like for construction. So just keep that in mind, that it's going to become, a little bit more intrusive for the client, and the better that we warn them up front of this, the less angry they're going to be in the end when we really start asking more questions as things progress with COVID. We don't really know what the future is going to hold, and so we're just trying to do our best to protect our clients and our collateral too. So I just wanted to throw that in there as well. Also, they changed it again, Bob. It's not 3 calendar days now; it's 3 business days. So at least we have a couple extra days if there's a weekend in the middle to get that verification.
Thank you. Thank you, Stephanie. Thank you, Bob, for covering that. Hopefully, agent partners out there, some of this might be, I don't know, too far into the weeds for you or not. I don't know. We wanted just to make sure that we took the time to, walk you through, the real important, critical changes taking place as the virus impacts our business, which ultimately impacts your clients. So the better you understand and the more you're on the same page, we can all kind of be in the same boat rowing together with our mutual clients on that. So any questions on that, Kyle, over on your side?
Yeah, there's a couple different questions. So the first one is dealing with the kind of the seller side of this and kind of what to expect. It has to do with pre-approvals. We get a pre-approval from the buyers. Obviously, this is going to mean there's probably a little more scrutiny towards the end of the transaction. There's a possibility this person might not be able to get their loan. The question really is, will people at the elevated risk get a harder look at the end? Is that correct? Does that sound about right?
Yep.
Yes, they will. And in fact, it might be a good idea when you're looking at offers for your listing to check with a pre-approval lender to make sure that they have addressed this in their pre-approval. Have they already checked with the employer to see what their answer is going to be about the impacts of COVID-19? Definitely worth asking, I think, when you're looking at offers.
That's a great idea.
And And stay in constant contact with your lenders. It's really important. I mean, really, they should be if they're a good lender, they should be keeping in touch with you. But you know, don't let even a week go by without touching base, just because things are changing that quickly. We're literally getting, you know, updates multiple times a day, even on different types of products or appraisals or, you know, anything. So, you know, I like to keep everybody involved in my transactions, both the buyers and the listing agents, so they know what's going on. Obviously, we can't extend information to a listing agent necessarily, but definitely we'll be having the conversations with our buyers agents and then letting you relay the information to your the listing agent.
That's great. And then the other thing, I'm just kind of curious, as far as with our agents, with their buyers, what can we do as agents, as realtors, to help you guys, especially with the process? Because I know a lot of the buyers, especially in transactions, are asking, what happens if I lose my job? What happens if it's going to be a temporary layoff? That type of thing. I'm just curious, what do you guys suggest we can talk to our buyers about to help the process through? Anyone?
I mean, I'll go again, but I feel like I'm talking too much. Honestly,
you're doing fine.
You know, just, you know, the constant communication again is really the most important thing. They need to be aware that we are going to really pressure them for a lot of information right in the beginning. So the more information that they can give us upfront about the true impact that this virus is having on their ability to repay a mortgage now, tomorrow, and 4 weeks from now, and 6 months from now, we need to know that right now. So if they're in an industry that's high risk, or even if they're not, and they get furloughed or their company decides to downsize and they get laid off, I mean, you know, sometimes they try to, you know, squeeze things through. Well, they're not, it's not going to get through. So they might as well just let us know right up front. And honestly, I'm trying really hard not to freak everybody out, but just explaining to them the importance of this and why, you know, we don't want to end up in a situation like we were in 2008, where we're in a total nightmare of foreclosures and things like that. So, and I'll go over a couple of the, you know, the conventional and the FHA and VA and stuff, guideline changes here in a second. But really, Kyle, the best thing to do is just educate them right up front. You know, that the mortgage industry is tightening their guidelines, so this might feel a little bit more intrusive, especially to those people that are affluent, have a lot of money. A lot of those people don't feel like they should have to go through this kind of scrutiny, but it's not just like the virus, it's not discriminating against any type of person. We have to do this for everybody. And so the more they know that this is just the way it is right now, and to try not to get too upset about it, the easier it's going to go on everybody.
Sounds good. I see a couple other questions, but let's go ahead and move on, and then we'll hit these questions at the end, okay?
No, that's good. Good point, Kyle. So next we'll have Stephanie, and you've heard her a couple times with some great, great feedback and some great input.
Talk a lot.
No, it's all good stuff. It's all about sharing and learning, right? We're sharing.
22 years in the industry. I've been through all the booms for the last 22 years, the bad ones, the good ones, and all that. So I tend to have a lot to say, but I'm going to do this really quickly, guys. The main thing, I'm not going to go over refinances at all on this call like I did yesterday with my group. I'm just going to focus on the purchase stuff. The main thing to know is on Freddie Mac and Fannie Mae. And by the way, all my other loan officers out there, if I miss anything, I probably will. So please feel free at the end to, you know, say anything I forgot or missed or whatever, but because it's been a lot. Primary homes, we can still do 3% down on conventional. The credit score has not changed. 620 is still the minimum. But there's been a change on second homes. We need 20% down now instead of 10, and we need 25% down on non-owner occupied investment rental properties versus the 15% we require now. So that's the main stuff that you guys need to know. That rest of that stuff is kind of stuff for the loan officers when it comes to like mortgage insurance and underwriting type and stuff. I'm not getting into that stuff with you guys. I'm going to keep it simple. So for FHA, if you want to go to that next slide, we used to be able to do 580 credit scores on a manual underwrite. We do not have that capability anymore. It's just a flat 620 for both VA and FHA. You have to have a 620 in order to get a loan right now with either of those. Those are really the only changes for those two programs. Not on here, my slides are on here for some reason, but I'm going to go over jumbo really quick. The jumbo market is, it's taking a hit. Let's just say that. There's not a lot of lenders doing jumbo loans right now, and the ones that are still doing them, they're tightening their guidelines pretty significantly. They're also, the rates have increased quite significantly on those as well. And it's really due to, I don't know if you guys know how jumbo loans work, but most of them are portfolio loans that are being accessed by those of us that don't have the money to or want to be in that market or don't have our own funds to lend. And so when clients take out their depository account, it leaves, not a lot of money left for them to spend on portfolio type loans, especially ones that are in the jumbo space. So instead, we are doing first and second. So in other words, we're keeping our first mortgages at the conforming loan limit, which is $510,400, and then a second behind it. So again, reach out to your lender, make sure if you have a jumbo client that's in like the $1 million range, that may not work with their situation. So again, the communication with your lender, hopefully, which is us, just, let us run the scenarios and let you know what we have available. We kind of are all in this together. So if there's something that one of my colleagues at another company can't do, but I might be able to do, we really are trying to help our clients out and getting them referred to each other. So that's really a lot on the most that I can tell you to do on the jumbo. They're doable, but the clients that fit into what's available right now is a very small box. So I'll leave it at that. Also, just a side note, there's no cash out on refis currently in the jumbo market. USDA, no changes yet, as far as I know, but somebody that does a lot of USDA that might want to speak up there. I'm not really sure. And then just worth mentioning really quickly, they're limiting cash out on all refinances to $50,000 after the liens that are on the home are paid off. So if somebody has a first and a second, they can have $50,000 extra in cash out. That's it. Self-employed people are only being able to take cash out on a case-by-case basis. So if you're self-employed, we have to be able to prove that the reason that you're taking the cash out is for the betterment of your financial situation, and it's not to just taking out money to live on. It's, paying off credit card debt, combining a first and a second with a rate being lowered. It's got to be a pretty big tangible benefit in order for them to approve any type of cash out for somebody self-employed. Okay, that's it for me. How was that for fast?
That was good. It was very, very
impressed.
Yeah, that was a very, very efficient, but covered it. So hopefully, again, a lot of information is coming out of the fire hose at our RE/MAX partners. So my advice is always, reach out to your respective loan officers to get the skinny on everything. They're the professionals, just like you are on your side of the fence, so we can both work together.
We do have a couple of questions. Are you good with that, Todd?
Yes.
All right. So I know one of the questions that popped up, which I think is a great one, is if we have the ability to close earlier in a transaction, should we try to push for that? What do you guys say at this point? Yes?
Yeah, I mean, if that's a possibility.
Yeah, absolutely.
They're not going to let us move up loans until we're clear to close. But yeah, I mean, absolutely. I had one that we closed a week early that closed about a week and a half ago. And the guy was in the hotel industry. And, you know, he wanted to get it closed sooner than later because he, you know, had a feeling his hours were going to get cut, and we were able to get it done about a week early for him, and he was able to close. So yeah, if it's possible, absolutely. I mean, that's a great idea.
Good.
Yeah.
And one thing I would throw in there for the agents is if it's a possession issue, the seller needs to be in that house. Keep in mind we can do the rent back, just to get it closed early and keep the seller in there. And I think that'd be the way to do that. I think that'd be a great policy. So that's good to hear.
Jackie had a question.
Yes.
I would say that we need to be careful though. So if someone wants to move up because they've been notified that, hey, at the end of April, May 1st, I'm going to lose a job, then like that's not okay with moving that up, because we know they're not going to have a job. That yes, they have it now. No. So
What I'm hearing is you don't want really all the information why, right?
Right.
Okay.
well,
Another note on moving our purchases up. I just wanted to reiterate to those of you that don't know that we still are very much a purchase-focused company, and all of our purchase business will always take precedence over any refinance business we have. So don't get worried that you're gonna, like the big banks kind of do a first in, first out. Regardless, we are not that. We do not work that way. Our processors know to pick up our purchases first every time, 100% of the time. So definitely we can still close purchases quickly. Because of the appraisal situation, we're asking now for 30 days for closing. I know we like to push that we can do our 21-day close. And, in an emergency, we probably still could make that happen. But we probably have to pay that $300, $400 for a rushed appraisal and that kind of thing. So anyway, I wanted to make sure you guys are aware that you are our most important clients, and your clients are just as important as you are too. So that's it.
Awesome. Thank you.
Well said.
And one other question was about, do you guys believe these policies will survive the pandemic, or will things go back to business as usual after it passes? What do you guys say?
Okay, go Jason.
Or Todd?
Well, I was just going to say my personal opinion. In fact, I was on my weekly touch base call with Lori, kind of talking about some of that stuff. And I honestly, again, I don't want to beat a dead horse about this is not 07, 08, but it really isn't. I mean, they're not going to have a Financial Reform Act. They're not going to have, CFPB created all over again on this kind of stuff. I mean, this is I personally think this is a temporary thing to weather the storm, focus on quality. We got to do our own servicing now, making sure that people can pay back their mortgages. And just like the economy, I believe the economy in a matter of time. I shared an article with your managers and my Leco team about Goldman Sachs and the three big investors that, I mean, once we get a handle on this, we are going to see the trajectory in the economy through pent-up demand, whether it's me getting back to Hawaii and finishing my vacation or buying stuff or following through with their home purchase. This comeback curve is going to be, I think, just tremendous, in my personal opinion. I think the guidelines will eventually ease back up. It may be step by step, but I think we'll get back to some normalcy eventually. But go ahead, Jason, or anybody else, or Jackie.
I think that, yes, the normalcy, but some of the things that they've added, I don't see as a bad thing long term, but I don't think to that extreme. Like we might be able to keep some things and trying to, like, I can't think of anything good right now because it's been a lot that's been coming out. But I think some things they may keep, and it wouldn't be a bad thing necessarily. But I don't think that it's going to be like this craziness the entire time or after the pandemic of everything.
Thank you.
Awesome. I have a question from Ruth. Ruth, I just unmuted you if you want to go.
I think it's the other Ruth.
Oh, sorry.
That's okay.
Oh, hold on. There's another Ruth. Un momento. There we go. There we go. Ruth, are you there?
I am.
All right. What was your question?
Well, I had two. Because will there be a charge for a loan lock at 60 days because we're going to have you know, there may not be ability to close these right away. And then also, will there be flexibility for possession after close over 60 days? Because right now, your possession after close is cut off at 60 days. So if you've got a seller that can't move, such as an elderly person that can't get into the assisted living because the assisted living is shut down, is in lockdown, and they have to stay in that house, and the new person that is purchasing has a loan and you do a possession after close, the most they can stay is 60 days. Is there going to be some flexibility on that for the people, the sellers that can't move yet?
I haven't seen any changes to that yet. You still have to occupy
Not
it
at
on
this
the
time.
60th day for an owner-occupied purchase. So, I mean, that could be something that's coming, but I haven't seen anything on that yet. So you still have to occupy on the 60th day for owner-occupied. The difference in rate lock pricing between a 30 and 60 days, I believe it's 0.5. Yeah, a half a point. So 0.5% of the loan amount. Maybe Todd can speak to this more, but I haven't heard of anything where they are going to, you know, charge a 30-day lock price for a 60 yet.
Okay.
I have not heard anything specific. I've been with companies in the past during unusual times where they have done that. They have locked it on 60 but honored 30-day pricing. I think that would be something that's potentially on the table down the road. And Stephanie might jump in on this too. Again, we're a purchase company, number one. So as far as getting the loans closed on time so locks don't become an issue, that's our priority. Our company is very liberal on our free extension of basically a week. And then we've had revised extension guidelines that are very minimal, even going beyond the free 7 days. I mean, I think as a team, we talked about this. I mean, we technically can go 45 days out, and it's a minimal, you know, cost to the borrower on that front. So if anybody wants to add to that.
Depending on loan amount, it's basically a 7-day extension. I think, were you asking if we needed to lock on a 60-day because we were having longer closing dates, if we had that ability? I thought that's how I heard it. But the answer to that question is yes. If somebody is wanting to lock for 60 days, they absolutely can do that. But if you're asking, we're forcing people to lock on a 60-day, no, not on purchases. I don't foresee that happening. If anything, it would be 45 days, and I'm so far since I've been at this company, I've never seen them do that. So I don't think so. No on the 60, no on taking possession after 60 days. And the rate extent, we do give the week free as long as we lock a 30-day loan. We can give the client 7 days for free on an extension, and then it's 0.015% of their loan amount per day to extend it after the 30 days. Or if they need another full 30 days, we can just charge a 0.125 overall charge. So 1/8 of the loan amount, and then they get an additional 30 days.
I think one of the concerns with regards to the possession issue is now, as of this morning, there are no evictions allowed for 90 days. So if you've got a renter, that renter can stay there for 90 days for no, and then your loan goes in the toilet because of the government mandated 90-day no eviction rules.
Yeah, at that point, you just have to extend the closing date out so that it matches, and then, you know, they can either lock in on a longer lock, or they can play the market and potentially do their extension. But unfortunately, it's not a EMG rule that at this point. It's still the agency, the Freddie Mac, Fannie Mae, the FHA. No one's made that change at this point, and maybe they will. Hopefully, that could become a consideration. But at this very moment, at this point, the only option you guys have really is to extend your closing dates.
And hope they can get an extension on the loan lock.
Yeah, I mean, for the ones that are in process right this moment, yeah, yeah, hopefully they can get it. What we would do in that situation is we would do we can extend twice. We can do a relock twice at an 8% for each 30 days. So we would be close depending on when the rate was locked. But for any future deals that you have where there's renters and tenants and stuff involved, those are going to need to be just longer closing dates.
Good points on that. We'll have to, I'll touch on one thing. We got to kind of wrap up. And to that, Ruth, this is all new. I mean, relatively speaking, it's new. And we're getting guidance from Fannie and Freddie, every day on different changes. And I'm sure if this comes up, they'll have it on the table. They'll work through it. They'll come up with some options. They'll get it down to the lenders. We'll get it out to you. That kind of a thing. It's just, some of this is, we don't have answers to everything because it's just so new and things are so volatile and changing so quickly, but that's awesome questions. Want to touch on one thing, the guarantee to close Kyle brought up. Unless my team wants to correct their boss, we are still honoring the guarantee to close on time.
So
I see Jason.
We need to check with Bill on that, because we usually, even if the appraiser is the problem, we still honor that and we give the $1,000 to each side. But in this environment, I don't know if we need to check with Bill. Let's get back to them on that. I don't know if we're going to, because that's a 21-day guarantee close. And if we have appraisers taking 3 weeks, I mean, we're going to be dishing out $2,000 on a lot of transactions.
So Kyle, let's table that one and we'll get some clarification. I'll get it to you, then you can get it out to respective people if that works.
Sounds great. No, I think that's great. All this information has been great. So thank you, Todd, and thank you all the loan officers for helping out with this and going through it. Times are changing, as I think Bob said a couple times. Every day we're getting new material on the mortgage side. We're getting it on our side as well. So probably the best thing to do is a hang in there. One of the best things I think that we have for this company and this partnership is having that partnership with Equity Mortgage Group and you guys with Equity, RE/MAX Equity Group. And, you guys do a great job and you stay in communication with the agents and you know what you're doing. There's a lot of questions. Even somebody had a question about, appraisals outside of our company. They haven't had any issues with our lenders. Well, there's a reason why for that. You guys are great. It's not like a lot of the big banks and things like that. So I appreciate this partnership, and this Zoom call in and of itself shows why this is such a great partnership. It's great to get this information out to everybody. I know that Todd's working hard behind the scenes with the loan officers to make sure that all the updates that happen get flooded out, and all the loan officers will be touching base with their agents as well. So I think Todd and I we'll probably keep doing this on a regular basis, probably not every week, but every probably 10 days, 2 weeks, something like that. If you guys do have any more questions, please reach out to your loan officer in your building. They can help you out, and then they'll share all that information and we'll get it out to everybody that way.
Thank you, Kyle. Thank you, partners. We value and we appreciate you and the partnership and your support. Please stay safe, your families, stay healthy as we weather this storm together, but much appreciated. And here's our final.
There we go.
There you have it.
Thank you. Thank you all for taking the time today.
See you guys.
It was helpful for you.
Thank
Bye.
you.